That's
No, I'm good. I'm good. Well, thank you guys, thank you, Marty. Appreciate you having me. Um, I was a late addition, and for our audience here, hope you'll bear with me as I kind of strung some stuff together to just talk a little bit about what we do. Tower Rock Oil and Gas, a mineral and royalty acquisition company. We have, uh, uh, excuse me, I'm going to present here. I've been in the oil and gas industry for 20 years now. Graduated with a petroleum engineering degree out of UT, and and uh, and have been dedicating my entire career pretty much to the mineral and royalty space. So, um, is anybody on here that can tell me whether they can see my screen here?
Yeah, we see it. It's good.
Good. All right. Anyway, a lot of people don't understand minerals and royalties. A lot of people think that we're just another oil and gas kind of wildcatting E&P company, and we're not that at all. Minerals and royalties are actual assets, hard assets. They're compared to real estate all the time, and they're a solid investment that have certain fluctuations and certain dependencies to the commodities, to the commodity markets, but overall, they're great investments. I've been doing this again for 20 years, very profitably. I've been able to have been a part of various pricing cycles over the years, and I've been involved with over 4,000 transactions totaling over $120 million, and have built several successful entities along the way. um, we have recently closed out our third fund. They've all been small funds. The last two have been uh, it's sub 15 million, and they both have been successful. A lot of people. Um, our main MO is to build a portfolio of assets that generates yield, has great upside, and has protected downside from the hard assets. And overall, this is a unique, alternative, asymmetrical investment opportunity. Um, the main things that we like to emphasize are, again, the protected downside from the hard assets. They're uncorrelated to the markets, meaning that if the stock market's doing well, I mean, are doing poorly, obviously that doesn't mean that it's going to hurt these assets. Same thing with the real estate markets. And in the same on the same vein, if the oil and natural gas commodity prices are hurt, it's not necessarily going to hurt your value one to one, and that can we can attest to that most recently with this double black swan event that we had recently. You saw oil prices. Everybody saw oil prices kind of depreciate tremendously in over a very quick period, and we saw 35, 40% of what they were in just a couple of months, and our assets did not decline that rapidly or even anywhere close to that. A royalty income obviously does get hurt, but the asset value remains attractive. Um, the main thing that I like to have people understand is that when we are out there buying and building these portfolios, it's very simple. It's actually very similar to any private equity firm that's out there that's looking at investing. If you're looking at a company that sells widgets, or if you're looking at a company that sells software, whatever it is, you're going to look at what they've done historically and what their potential is for future. I mean, it's the same exact thing, and then you're going to risk it appropriately. So what the risks on each individual asset that we buy are simple. It's the timing of the first production, how that production actually performs once you have it, and how it compares, or once it comes on compared to what you underwrote, and then what oil and gas market prices do along the way. So all of those will actually help determine what you actually do. But we always say that the money that you make is in the buy, and so we're properly underwriting all of these assets to make sure that that we're buying, that we're building a great portfolio, and the risk and the investment and the risk profiles vary from your safest investment, which would be one that is potentially a legacy producing asset that's been producing for a dozen years and that will continue to produce for several decades going forward at a flat rate or a very predictable rate. And then it could be something that's much riskier, something that is not quite yet producing, but it will be generating returns here in the next in the foreseeable future. And so once you've actually spent that money, there's no additional capital investment. You're generating the returns and you're waiting for that exit. So that's it's important to note that these operators that are drilling wells and completing wells on your real estate, they're incentivized to improve the value of their own assets, and they're improving the value of your assets, but they're the ones making all the capital expenditures. So we build these portfolios. We usually take the first 12 to 18 months, maybe even 2 years if we need it, to deploy the capital, but rarely is it that long. Then I stole this slide here from somebody else, but it helps me kind of illustrate. If you imagine that each of these different colors, as the cash flow is continuing to increase, is a different acquisition or new drilling or new development, new completions, etc. You can see your royalty cash flow build once you pass the deployment period and you're into what we call the development period, and your inventory will continue to get developed until at some point in the future where it peaks, because you're going to run out of assuming you're not in an evergreen kind of portfolio, you're going to run out of inventory to get drilled. So the point of this illustration is to show that part of our management and part of what we do is to manage these assets in a way to make sure that we're capturing the best value possible. In some instances, that requires selling an asset on its own, but for the most part, we're trying to build a portfolio that has a ton of great drilling opportunity, and then sell that before that peak ends. It's just like anything else. You want to sell it on the upswing. You want to sell the portfolio on the upswing and get out to maximize the returns. But that's really it. I mean, I really don't have a lot to show kind of a lot of you guys, but I do want to emphasize one thing. I go back to the protected downside on these types of portfolios, and I think it's important to note that on some of the I'm working on actually an investor report right now for Q2, and one of the things that I think is important to note is that in this last quarter was one of the worst performing quarters in the oil and gas history, going back into the 80s. And on an annualized basis, our net income for Fund 2 was still a 6.8% yield. 6.8% is not really very good by our standards. But when you consider that period was so poor, I consider that to be pretty good.
Hey, Oscar, a few questions. So where are you now in terms of, how do you feel things look for the next year, 18 months, or is that all dependent on where COVID is? And what is the opportunity for distressed investing right now, et cetera?
Yeah, that's I mean, I go back to hearing some of the things that some of the private equity panels were discussing. There's so many similarities. I think for the one from this morning in particular, I was hearing the conversations, and you could have easily just substituted mineral and royalty buying into all of those conversations, because it's very applicable. You're going to see some distressed assets. You're going to You're going to see some people that have debt that need to exit. And these are people that just have mineral assets. The mineral assets themselves aren't in trouble. It's the people that are in trouble, right? So the people have gotten themselves into a position in the energy space or anywhere else in their other financial situations where they're going to need cash. And we offer liquidity in an otherwise illiquid market, right? It's not like you can just go on any given site and sell your minerals at any point in time. So people will call us. There is going to be plenty of opportunity over the next, starting now, but over the next year to 2 years, where this will continue. The opportunity will be there for a while.
So you think there's a lot of over leverage in the space, and as you said, I think somebody once told me that a lot of the oil and gas is an older generation, maybe some baby boomers, and
Yep.
and they're also looking at things and like, should we have gotten out 5 years ago? And now today they're like, well, I'm not coming back, so I got to get out somehow, right?
Exactly. No, there's going to be all kinds of things. You're going to see people that are trying to sell because they are distressed. Again, not necessarily because their portfolio is distressed because they put too much debt on it, although that will happen. But there's a lot of people in this space that just need liquidity because they need to invest it in other spaces. There's also the baby boomers that say, hey, you know what, my checks are lower than I've ever seen. I really don't want to wait this out anymore. I'm out. There's just all kinds of reasons that you're going to see people talking about. And people were talking about the bid-ask spreads this morning on the private equity side and on mergers and acquisitions. It's the same here. The bid-ask spreads over the last several weeks, couple months, have been pretty high, mostly because there's a delay in how these commodities are how production is paid. And a barrel of oil that's produced this month in July, you're not going to get paid on until August or September. And so a lot of people that are receiving their royalty checks right now are seeing those April and May production months with the really low prices hitting their checks. And so all of a sudden those bid-ask spreads start to tighten a little bit more. They're more their asks because their royalty checks have gone down, have start to become a little bit more reasonable.
So just a good example that in 2009, bid-ask spread on private equity and venture capital was humongous. I mean, 40, 50% larger spreads. And then the year after, it went down to about 20%. So basically, the people that were really panicked and had to get out, they got out. And then the people that had to work it out, they were able to work it out. So probably oil and gas will go through similar cycles, et cetera. Although I don't know where's demand going to come through from, et cetera. So
that's exactly right. It's very similar. I think when it's all said and done, you're going to see a lot of people from all kinds of walks of lives that are going to need that liquidity, and that's why we're here. And I am focusing here on showing you guys some of the Fund 2 performance, just because again I'm working on that update for the investors from this one, and so it just happens to be handy. But you go back to how does this double black swan event hurt us? You can see on this right here, we're in Q2, Q10, 2010. You can see our cash flow got crushed, and our asset value got hurt. But overall, what that means to us mostly is that's going to delay our exit. Our drilling inventory is still there. Our footprint across the United States is really, really good. We're in 6 states, 12 major basins, 34 counties, 154 operators. I mean, the stats are great across as far as the portfolio goes. And so, and in addition, there's a lot of concentration in the Permian Basin, and the Permian Basin has traditionally been had some of the highest rig counts in the world. And certainly they're low right now, but they're not going to be low forever. So drilling activity will continue. We certainly predict that our cash flow will continue to go back up again. The best thing for low oil prices is low oil prices, as the old saying goes. I go back to that chart of the cycles that I've been through. The cycles I've been through plenty of them. And what's funny about it is when things are good, so many people forget and they think they're going to be good forever. And when things are bad, so many people forget and they think they're going to be bad forever. But that's just never been the case.
Yeah, I'm a big fan of oil and gas, so I think that politically there's a big demand for continued strong production in the U.S. So
for sure, and I think there's a couple of things that are looming. I think obviously the potential for there being a liberal. Liberal-sided and liberal-minded, head of government here over the next in the next election, and that doesn't worry me. I think a lot of people talk about fracking being a topic of conversation, whether that's going to. I really think the most likely scenario, if Biden were to win, is that he and the Democrats will put a moratorium on federal drilling on federal lands and drilling on state lands and stuff like that and offshore, and all that will do it'll force operators to drill on the private lands, and that's what we own, right? We own acreage across a ton of private land, so and that tends to actually help oil prices as well too. So I'm not that worried about it, and obviously operators are, because they've got a lot of federal lands to drill. But as far as fracking being on the chopping block, that's a pipe dream.
Fantastic, great. Well, it's Oscar. Thank you so much. I really appreciate it. We've got Hank Laguerre on. Hank presented before, but I think with COVID it actually really is winding down from a mortality point of view. Hank's going to talk about MD box and about the opportunity. So Hank, do you want to dive into it?
Yeah, I think Oscar needs to stop screen sharing so I can screen share.
No, I want everybody to